Bonds explained. How do central banks control the economy? Imagine a central bank as the engine driver of a country's economy. They have a few tricks up their sleeve to keep everything running smoothly. One of their main tools involves buying and selling bonds, which are like loans the government issues to raise money. When you buy a government bond, you're lending money to the government, and they promise to pay you back later with some extra money called interest. Central banks use bonds to influence how much money is floating around in the economy. They do this through open market operations, which means they buy or sell bonds in the open market. When they buy bonds, they pay money to the sellers, and that money goes into the economy. More money means people and businesses can spend and invest more easily, which helps the economy grow. But when the central bank sells bonds, it takes money out of the economy because buyers pay the central bank, reducing the cash available for spending and borrowing. This can slow down the economy if it's growing too fast or if prices are rising too quickly. These bond transactions also affect interest rates, which are the costs of borrowing money. When the central bank buys bonds and increases the money supply, interest rates tend to go down. Lower interest rates make loans cheaper, encouraging people to buy homes, cars, or start new businesses. On the other hand, when the central bank sells bonds and pulls money out of the economy, interest rates usually go up. Higher rates make borrowing more expensive, which can slow down spending and help control inflation. Besides bonds, central banks also set interest rates directly by deciding what is called the base rate. This rate influences all other interest rates in the country. They can also change reserve requirements, which is the amount of money banks must keep and not lend out. Lower reserve requirements mean banks can lend more, boosting spending. Higher requirements mean less lending, which can slow economic growth. The main reason central banks do all this is to keep the economy stable. They want to prevent prices from rising too fast, which is called inflation, or falling too much, called deflation. By controlling the money supply and interest rates through bonds and other tools, they try to keep employment steady and the economy growing at a healthy pace. So, in simple terms, central banks use bonds as a way to push or pull money in the economy. Buying bonds puts more money into circulation, making borrowing easier and cheaper. Selling bonds pulls money out, making loans more expensive and slowing things down. This balancing act helps keep prices stable and the economy moving smoothly.